And welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, January 6th, 2022, and I'm pre-recording this Trading Places Live for a bit later this morning. Futures, currently, we had a really rough day yesterday, and currently we have, let's see, futures are showing, well, looks like maybe we got some mixed futures. We've got the Dow futures up 65. S&P 500 futures are down 4.5, and NASDAQ futures are down 87. And that's been the bifurcation really that we've seen in the market so far this year, at least the relative performance. NASDAQ's been underperforming. Then we have the S&P 500 underperforming, and the outperformer so far has been the Dow. But yesterday things turned sour really across the board, and we're going to talk about that in just a bit. Let's see, let's go over today's agenda. So we're going to start off, as we always do, with the daily market recap from Wednesday. Then we'll get into talking technically, break it down. I'm going to bring up a group that really has not started off the year very well, didn't end the year well, and it hasn't started the year well, started the new year well. We'll get into that later, but that'll be during the break it down segment. Then talk about earnings spotlight. Earnings results, we really haven't kicked it into gear officially with the big names coming out of the banking sector. That'll be next week. Really over the next couple of weeks, we'll get things going. But we have seen a few earnings reports, and it hasn't been pretty. Mixed results, but for the most part, just selling on earnings. But it's a small sample size, mostly smaller companies. Definitely not representative of a lot of the growth areas and so forth. So anyway, we'll get into the earnings spotlight, talk about a few companies there, and then we'll wrap up the show with the three you must see. I'm going to pull up 3 Dow stocks that had rough days on Wednesday and take a look and see what's going on technically with their charts. All right, but before we get into any of that, let me take you over to earningsbeats.com. For those of you who are new, you can go over to earningsbeats.com and check us out. We do have a free Earnings Beats Digest newsletter. All it takes is a name and an email address, and hit that subscribe button. We'll get you set up. This is a newsletter that I publish 3 days a week, Mondays, Wednesdays, and Fridays. Very quick read, just a couple paragraphs and a chart, make it pretty simple. And I believe this is a newsletter that can really help with your trading. If you decide to trade any of the stocks we feature, obviously that's completely up to you. But it at least will highlight some of the things that we focus on at Earnings Beat, some of the things that are really important to us. So if you want to get to know us a little bit more, a little better, I think this is a great way to do it. So go to earningsbeats.com, scroll down, make sure you sign up for our free Earnings Beats Digest newsletter. The other big announcement I want to make, we're just 2 days away. Market Vision 2022 on Saturday. I've got Grayson Rose, David Keller, and Bill Shelby from StockCharts.com all joining me. If you click on this link here, it takes you back, gives you a little bit of information. But Grayson, Dave, and Bill have all been with us before, doing various webinars and so forth. You may not be as familiar with Bill Shelby. When I first started doing shows over at StockCharts, I actually worked with Bill for a while. He was hosting my show. And so, we talked quite a bit, not only about the market, but about the scan engine. Bill is the lead software engineer over at StockCharts, and he'll be with us. And we're going to do a joint session Saturday morning that will feature scanning. So if you want to learn a little bit more about the scan engine, there is no better person to listen to than Bill Shelby. He's the one that created it, and is always happy to share what he can to help everyone do a better job with the scan engine. So that'll just be one part of Market Vision 2022. Dave and Grayson be giving you their thoughts about how they're approaching the market and so forth. I'm going to talk about why I believe 2022 is going to be a crazy roller coaster ride. That's the best way I can describe it. And I think we're already seeing some of that excitement. It's going in the wrong direction right now, but you can kind of see the volatility already spiking here just in the first week. I think there are a number of things to go over. Last year, I was very bullish, thought we'd see the S&P 500 at 4750, which was a 1,000-point gain. It actually was 4766, so it was pretty close. Next year, choppy is a great word to describe. Volatile would be another one. Crazy, wild. We got a lot of different terms for it. Where are we going to be at the end of the year? Well, I got some thoughts on that, but I'm going to share that on Saturday. If you want to join us, it is free, but you have to be an earningsbeats.com member. And the way you can do that is if you go to our homepage, right at the top, there's a no-cost trial. That's all you have to do is sign up for a 30-day no-cost trial, completely free. This one, you do have to give your credit card. We have to get you set up in our system, but we will remind you before your 30 days expires. So if you don't like the service, if it's not for you for whatever reason, you can cancel. Again, that will get you into the event on Saturday. So make sure you go over to earningsbeats.com, click on that no-cost trial, get that started, and hopefully we'll see you on Saturday. I think it'll be a great event. Moving on, let's go into daily market recap. So the daily market recap, all I can say is it's kind of what I was expecting. I mean, the signals that I was seeing, and if you follow me at StockCharts, I'm mostly bullish. Some people think I'm way too bullish. But if I see problems, I will tell you I see problems. And I have been writing articles now for the last couple of weeks. I wrote one back in mid-November talking about how volatility was high. That's more of a short-term warning sign. Some of the signals I'm seeing now are more short to intermediate term. So it might not be just a quick down and a quick right back up. In November, when you look at the Dow and you see the Dow got hit, we came right back, set a new high. S&P down, came back, set a new high. NASDAQ down, didn't quite set a new high, but rallied back pretty good. We might be in for this for a little while to the downside. All I can say is that right now, I think the market is set up a lot like at the beginning of the 1960s. And we were in a secular bull market throughout the 60s, but we also had multiple recessions, multiple cyclical bear markets where you lose 20%, even though you're within the longer term uptrend. I don't know if we lose 20%. Again, we'll be talking about this more on Saturday, but I definitely think we got some issues in the market right now. And it's not just because of what happened yesterday or the last 2 days on the NASDAQ. Again, I was writing articles over the holidays. I thought it was going to be a rough start to this year, and that certainly is what it looked like yesterday. And it could get rougher before it gets better. But yesterday, just going through the numbers, the Dow Jones lost 392 points, S&P down 93, back to 4,700. The NASDAQ dropped 522 points, 3.34%. That's a huge drop in one day, kind of reminiscent of some of the drops we saw back in the pandemic, March of 2020. Haven't had a whole lot of those big down days like that, but we could see some more of them kind of scattered around. We'll see. Mid caps down 64 points, 2.25%. Small caps 35 points, almost 2.5%. There was really no getting around it. I mean, the Dow on a relative basis was the best performer, only losing a little over 1%. But we were up to 37,000. I mean, we had a 600-point turnaround on the Dow yesterday afternoon. So not good action. I mean, can't really sugarcoat this. Materials, best performing index, best performing sector, and but it only lost 1 penny. So materials down 0.01%, energy down 0.02%. So those were the two best performers, but all 11 were down, and you can see the reversals. So even though it was only down 1 penny, you can see from the high it was down probably about $2. Energy, same thing, pretty big reversal off of the earlier high. Then you get into the really weak areas. Real estate losing 3.25%. You can see falling back below the 20-day, not good. Technology finally taking this move down. We had a negative divergence in play, and we're back to that 50-day moving average. Apple, some of the bigger names in technology getting hit yesterday, so that drove the XLK down 3%. Discretionary down 2.7%. These last two right here, many growth stocks reside in these two sectors. Growth stocks were hammered on Wednesday. So just not a good look all the way around. Looking at the 10-year Treasury yield, we are moving higher in interest rates. I think that's going to be one of the headwinds potentially throughout parts of 2022. I don't know that we're going to have a huge rise in rates. We'll just have to kind of see how the year unfolds, but there's probably going to be a little bit of an upward bias. And while I don't think that's a horrible thing, actually, normally the rates going up is a good thing for stocks, because it's normally saying, hey, big money is getting out of bonds. That's what's driving the yields higher. And usually you do that to get into stocks. But you also could be doing that because you're worried about inflation. You don't want to be sitting in bonds when the inflation is rearing its ugly head. So you got to go from there and try and figure out, well, why is it going up? Is it going up because of inflation, or is it going up because it sees a great economy ahead? Well, looking at what happened in the stock market yesterday, I think we can answer that question rather definitively, because the market did not go up with the 10-year Treasury yield going up. Instead, growth stocks were slammed. So I would say, just basically looking at what happened yesterday, the market's nervous. It's nervous about inflation. It's nervous about the prospect of higher interest rates. And whether I think rates are going up and whether I think inflation's a problem doesn't matter. It doesn't. I don't think interest rates are going to go crazy. I think inflation's going to peak during the year, and I think we'll see it come back down the second half. But the market doesn't care what I think. Market's worried, repositioning. I'll say I think the stock market is highly manipulated from time to time. There's a lot of money at stake. Anytime you get a lot of money at stake, you got to worry about manipulation. I think there's all of that going on. But anyway, 10-year Treasury yield moving up, and I think that was a little bit of a spook for the market as well. The Fed minutes came out, and that was part of what prompted the selling in bonds and also the selling in the stock market. As far as economic reports today, we've got initial jobless claims coming out later this morning. Expected numbers 205,000. Last week was 198,000. November factory orders will be out later this morning as well. In October, we saw a rise of 1%. November, we're expecting a rise of 1.3%. Then December ISM Services Index, 67 is the expected number, which would be a drop from the November number of 69.1. So a drop from 69.1 to 67 is what we're looking for there. That is, that's the list of economic reports due out today. I can tell you tomorrow, Friday, we get the December non-farm payrolls number. By the way, Wednesday, we got the ADP employment report out, which showed jobs doubling expectations. But is that a good thing or is it a bad thing? Does it mean things are too hot? I mean, if the economy's too hot and we're hiring too many people, that could be wage inflation, could be very inflationary. And if the market's already concerned about inflation, that could have added to it. So that's another factor. So when we get this non-farm payroll report on Friday, what the heck do we want? I mean, we've been wanting to make sure we've got to, strengthen the economy, but maybe we don't want it to strengthen too much. Maybe we want to see a lower number than expected. And we're right now looking for an expectation of 400,000. Two other economic reports coming up. And I always like to, point these out in advance because, again, inflation is the concern or one of the major concerns in the market right now. Next Wednesday, January 12th, and Thursday, January 13th, we get the CPI and the PPI respectively. So those are the December CPI and December PPI numbers coming out. That will be next Wednesday and Thursday, the 12th and the 13th. I would mark those on your calendar because if those numbers come in hotter than expected, that easily could help to trigger another sell-off in the market. Or maybe the market's selling off in anticipation for that news, and maybe we get bad news and we get the bounce. Who knows? But all I'm saying is right now the market is most likely beginning a downtrend. And anytime that happens, you want to be very careful. I would use strength to lessen my positions. If I was in positions, I can tell you that I am sitting in cash. I don't trust this market right now. And I've been writing about it, talking about it for the last couple of weeks. And so I'm not surprised by what happened yesterday. And I wouldn't be surprised to see more selling ahead. All right, let's go into talking technically. So First of all, let's just look at the S&P 500. I'm just going to show you some of the carnage if you didn't see it yesterday. I mean, starting around 2 o'clock, the minutes came out and there wasn't much buying. The S&P 500 initially went up, I don't know, maybe 10 points after 2 o'clock, and then right away began selling. And you can see we sold off from this high, which was up near 47, I guess it was about 47.86. We lost almost 2% on the S&P 500. 2% of the value of all S&P 500 companies in 2 hours. Pretty crazy when you think about the value that was lost, the trillions lost in value. And then we got the Dow. So the Dow was the best performer yesterday. So if you take a look at this chart, you can see at 2 o'clock, I mean, we were up not far from 37,000. I mean, we were sitting, what, 36,925 maybe, right after the Fed minutes. And then we were down from that point more than 500 points in 2 hours on the Dow, which was almost 1.5%. Again, pretty big number. How about the NASDAQ? NASDAQ was just selling all day long. It started back on Tuesday morning, and it hasn't really stopped. We got a little bit of a reprieve late in the afternoon on Tuesday, but by Wednesday, we gapped down and just accelerated to the downside. Growth stocks don't like higher interest rates. Growth stocks don't like inflation. So a lot of the growth stocks reside on the NASDAQ, many growth stocks. And that's what drove the NASDAQ. And that's what's been driving the NASDAQ down on a relative basis. It's all about growth. And right now, growth is out of favor. Looking at the small cap index, this is the small cap or S&P 600 small cap. Same thing, 2 o'clock on, just absolutely brutal. Big move down there. That's about 32 points, more than 2% in the last 2 hours. We lost on the small cap index. And then you got the mid caps also not looking good. And you can see all of them very similar, but the selling took out some recent support levels on most of the indices. And that is what's bothering me. If you look at the S&P 500, we went down and closed below the 20-day. We also closed below the breakout level. And the reason I think this is more significant now than maybe in the past where we've had breakouts and failed to hold them, like here, we failed to hold it and then went higher, or, came back up again. Right now, we've had a negative divergence on the weekly chart on the S&P 500 since May. Every time we broke out. So we went down in May and we bounced in May and came back up. And from that moment on, every one of these highs has been accompanied by a lower weekly PPO. Eventually, there's no guarantees, but eventually that tends to reverse itself at some point. Either we take off and the PPO takes off and eliminates that negative divergence, or we get the selling that takes us back to the center line and maybe even the negative territory. If the market gets weak and we see a lot of fear coming into the market, we could easily go down below the 50-week moving average and we could go below that center line. So I'm not very comfortable right now with the market, as you can probably tell. And this is from somebody who still believes long-term we're in the middle of a secular bull market that's going to go on for another decade. So if you're listening to this and you're, wondering long-term, I don't see anything long-term that's going to take us down unless I'm wrong about inflation and inflation is just getting started and it's going to persist for years. Obviously, nobody knows that right now. I don't believe that's going to happen. I think a lot of this is being triggered by the pandemic. And I think we just have to get through this period. So I think the next 3 to 6 months is really what we have to be careful about. And then I think we'll be okay. So from a longer term buy and hold perspective, I'm actually still very bullish. I mean, you still have to do what you feel is comfortable for yourself. I can only give you my opinion. It may be right, may be wrong. But I do think we're in a long-term secular bull market. And whatever happens here in 2022 is just going to be a part of that. I mean, we're spoiled by this since March 2020 bottom. I mean, we have gone up so much. We've now more than doubled in 21 months. That just doesn't happen. Now, it did come on the heels of the pandemic where we lost 35% in a month, which was crazy. But even if we hadn't lost that, I mean, where we were at 3,400 and where we are now, 4,800, that's been a huge move in 21 months, even if we forget about these lows. So pulling back for a while wouldn't be a horrible thing. And so I just wanted to make sure, that we keep things in perspective. That's probably the most important thing about looking at the market. Media is going to scare the heck out of you. I can promise you that. If the market tanks and moves, if the S&P were to fall back to even just 4,300 from where we are, that would just be a 50-week test. I mean, if you look back, we've seen that multiple times. That happens, and we've been going straight up. So that wouldn't be a horrible thing, considering, where we were and where we've gone to. Pulling back to 4,300 wouldn't be anything. But if we pull back to 4,300, you're going to think the sky's falling based on the media, and that's what you have to deal with emotionally. So anyhow, I could go on and talk about this all day, but I think you just have to be really careful, and I don't know what that means for everybody. If you're long-term, maybe it means nothing. Maybe you just stay the course. If you're short-term, well, it's up to each individual. I think that the market is showing some signs that we could have trouble ahead. And I think it may have already begun, but we're going to see. We'll find out. I don't know if I'm going to be right or not, but I just give you my thoughts. All right, moving on to break it down. What I did is I ran a scan, and I was just doing this out of curiosity. I did it literally right before the show started, and I thought this would be great to show. So I looked at software and semiconductors, and you can see I added the bracket here. So I'm looking for stocks with a 20-day average volume greater than 200,000 shares. So I don't want the real illiquid stocks. I want stocks that at least are averaging a couple 100,000 shares over the last month or so. And the group is software or the group is semiconductor. So it can be in either group. And the way you do this is you put the double bracket before the group and the double bracket after semiconductors. So you're saying it's stock, it's this volume, and it's one of these two groups. And 45 days ago, a couple months ago, the scooter was greater than 90. And now the scooter is less than 20, meaning that we have these stocks that come up on this scan have fallen from grace. And semiconductors, not as much, but software has really taken a hit over the last week or two. And even more so over the last couple of months. I know, Microsoft was holding it up for a while, but there have been a lot of software stocks that have been getting hit since the November high. So anyway, I just ran this. I was like, how many of these stocks, would have fallen from a scooter over 90? If you don't know what a scooter is, StockCharts technical rank. It's kind of a relative strength indicator. And when a stock is doing really well versus if it's a large cap and it's doing really well versus its large cap peers, in other words, been outperforming them on a momentum basis, then it's going to get a high scooter rank. And when you get above 90, you're one of the top stocks in the market. When you go down below 20, obviously you're no longer performing very well relative to your peers. And so I'm just looking for these stocks that have really changed character over the last 45 days. So I ran this scan, and these are the scan results I got. Here, 21 companies in software and semiconductors. Only one semiconductor came up, by the way, Skywater, which I'm really not even that familiar with. All the others here were software stocks. And you probably know some of these names. We've got Digital Turbine. So let me pull up the chart. And you can see where we were 2 months ago, near a 52-week high. And then literally 1 month later, we were setting a 52-week low. How do you go from 52-week high to 52-week low in 1 month? Well, you're nervous about inflation. You're nervous about higher interest rates. And those are the two things. That's kryptonite to growth stocks. Seriously, those two things will kill valuations in growth stocks. And so apps being a really fast grower, folks just said, hey, we're selling. Now we did get a little bit of bounce. Now the selling's kicked back in again. We don't want to go down and lose. You can see the reversal that took place right here at this low. We don't want to lose that level. But there's a story for every one of these stocks. Asana, again, very, very strong performer here in November. This was a stock I was very, very close. This made my final cut in terms of portfolio stocks. We have some portfolio stocks. Growth stocks are not doing well at all right now. But this was one that literally I was ready to pull the trigger on in one of our portfolios. And I just looked and I thought, it had just risen so much. I was afraid from 30 to 140. And thankfully, this one didn't go into the portfolios because we've now seen about a 60% drop in 6 weeks, 7 weeks. It's been crazy. I'm not going to pull up all these, but you can already see what's going on in the software space. Net, Cloudflare, this has been one of the best stocks over the last year. Look at this huge move from May all the way through November, 60 to 220. Well, we're back down to 100 in 6 weeks. So all of a sudden now 60 to 105 doesn't seem that great anymore. So anyhow, these stocks are really getting hit. And the problem is they just don't seem to have a floor. They just don't seem to have an area where folks are buying. Look at this support level right here on Cloudflare. We pulled back at the end of September and volume was pretty heavy. The buying was pretty heavy coming off of that low. I would have thought 110, great area. We went right through that yesterday like a hot knife through butter. So you got to be really careful with these software stocks. All right, moving on to earnings spotlight. So I just want to point out some of these charts some of these companies that have already reported. Smart Global Holdings, here's a semiconductor. I talked about this on the show, I think it was yesterday. I would have thought the 20-day would have been a pretty good support area. The breakout here at 62.5, 63, I would have thought would have been a great area. It went right down through both of those. Look at the volume. That's an ugly post-earnings candle. That's not the only one. RPM reported yesterday. You can see the high wave candle. It's a big volatile day, high of 100, low of 94 and change. And we kind of right in the middle. It's a little bit of like a spinning, well, it's not a spinning top because it's not at a top, but it just looks like a pretty volatile candle. I don't think anyone can argue that. Another company that reported, Simply Good Foods. Big move to the downside, down 8% after reporting earnings. They beat earnings, 43 cents versus 35. Market said, great, we don't care. UNF, I think this might be one of the banks. It's definitely financial. Oh, no, it isn't. It's business services, my bad. Anyway, the company missed earnings. And by the way, RPM also missed its earnings, 79 cents versus 86. Here's UniFirst, $2 versus 215. But look at these candles. They're all looking pretty familiar, coming out with, mixed earnings results, but almost all of these companies getting hit pretty hard after earnings, the trading after the earnings came out. So got to be careful with these earnings reports coming out. We do have things picking up, like I said, over the next couple of weeks. All right, last thing. I'm going to give you the 3 you must see, and these are 3 Dow stocks. I'm going to start off with CRM, which is in that software area. And we'll pull it up on a relative chart. Just going to give you a quick look at these. Moving down sideways, nice little flag, bear flag, tested the 20-day and then dropped. This looks like lower prices to me. Microsoft lost that double bottom earlier in December. That is not good news. So I could see this one going down at least to 305, maybe down to that 280 level. Be careful there. Last one, Nike. Excuse me. Nike, after gapping up, now going back down, likely to fill this gap back to 157. So Nike not looking that great. All right, that's it for me. Again, I just want to make sure everybody is aware of this. Market Vision 2022, all you have to do is go in and at least become a free trial subscriber of Earnings Beats. And if you do, all of our members are coming to this Market Vision event for free on Saturday. No additional charge. But we do want you to at least be a member and try our service. All right, that's it. Everybody have a great day. No more shows the rest of this week. Be careful out there. Hopefully we'll get a reversal. No guarantees there, that's for sure. But anyway, everybody have a great rest of your weekend, and hopefully I'll see you on Saturday. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.